Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Jack Willis, co-manager of the Liontrust Sustainable Future Corporate Bond Fund, which features on our Wealth shortlist of funds selected for their performance potential. So Jack, the fund typically invests in investment-grade corporate bond funds, but has a sustainable mandate. So what does it offer to investors, and how might that differ to a typical corporate bond fund?
Yeah, so the overarching investment philosophy of the team is that sustainable companies have better growth prospects and are more resilient than the market gives them credit for. Now, as fixed income investors, we're naturally born pessimists. So clearly we're more focused on that resiliency of the companies we invest in. And we truly believe that incorporating that sustainability analysis helps us to identify higher quality companies that are better managing those unforeseen downside risks from mismanagement of key sustainability trends. We believe that our fully integrated sustainability approach allows us to invest in a more concentrated portfolio of high quality companies where we have greater conviction behind the quality of the management within those organisations. So typically within the fund, we'll have between 60 and 100 individual bond holdings. The fund currently has around 75 holdings, whereas for a typical corporate bond fund, you'd see closer to 200 individual bond holdings. And we think that that more concentrated, high conviction portfolio in high quality companies helps us to deliver outperformance from credit selection over time.
And how well compensated are investors for lending to companies at the moment, and what's the opportunity set looking like?
Yeah, look, there's no denying the fact that the compensation on offer within the corporate bond market has clearly come down quite significantly over the last year or two, the significant tightening in credit spreads that we've seen. But, with all-in levels of yield still north of 5.5%, we still think that it's a really attractive asset class for investors. And you also need to put that credit spread tightening we've seen into context. We actually believe that it's been a fairly fair representation of the underlying strength of corporate balance sheets. Corporate fundamentals, particularly within investment grade market, remain at robust levels. Whilst we've seen some deterioration from the sort of recent highs that we saw in those metrics, we're still at really solid levels within investment grade. And if we couple that with the fact that there's a really robust demand for credit given the all-in levels of yield, that should continue to support credit spreads as we move forwards from here. So we still think that it's an attractive investment opportunity. Clearly, in terms of specific opportunities in a world of lower credit spreads that are closer to fair value, credit selection becomes an increasingly important factor in overall fund returns. And the fund has a particularly strong track record historically of delivering strong performance from credit selection over time. Areas where we still think is the most value within the corporate bond market, particularly within financial sectors where, as I said, those fundamentals are actually still at or near to record highs, but they continue to trade wide of non-financial companies. So we think that actually there's significant value there within the financial sector. And similarly, actually, within the underperformance we've seen within the utility sector, obviously affected by the issues within the UK water sector in particular, but we think there's been a disproportionate sell-off across what remains still a relatively defensive sector and now has actually more attractive levels of spread wider than the sort of more generic corporate bond market index.
And you mentioned the water sector there. That's an area of the market that's been under the microscope in recent times. What do you think are the prospects for investors lending to companies there?
So we've actually turned a bit more positive on the sector, particularly following the Ofwat final determination that was published in December. Uncertainty is ultimately a problem for any investor. So having a bit more regulatory clarity over the regulatory regime from Ofwat, but also DEFRA, should provide investors with a bit more certainty around how the sector should perform going forwards. Clearly, whilst there's more regulatory certainty, there is going to be a significant step change in terms of capital expenditure for the sector, with around 100 billion of allowed investment over the next 5 years. And whilst that clearly creates risk, we actually think it's a positive opportunity to get access to a sector that's looking to change ageing infrastructure and find attractive returns within a regulated structure. So we actually think it's a more attractive prospect than what it was before the final determination. But ultimately, it's important that still to be very selective in terms of the companies that you take exposure to. We only want to take exposure to the high quality names within the sector that have a credible path towards operational performance improvements whilst delivering good value for customers against a sort of rising water bill backdrop for the first time really since privatisation.
We've seen interest rates rise significantly in recent years. How are the companies that you invest in dealing with that?
Yeah, I think it's fair to say that probably everyone's been surprised by just how well and how resilient corporate credit has been in the face of a higher interest rate environment. But as I sort of touched on briefly before, corporate fundamentals, whilst we've seen some weakening from the sort of all-time highs where we were, we're now just back to sort of longer-term average sort of levels. So we're still at a really healthy level in terms of underlying corporate fundamentals. Yes, interest coverage has weakened, but investment-grade companies did a really good job of terming out their balance sheets and lengthening their debt profile while interest rates were very low. So we haven't seen a marked deterioration, but it's something we're keeping an eye on. But we're expecting levels to sort of stabilise in and around current levels, sort of in line with longer run averages. So still a very robust picture for your sort of average investment grade company from a fundamental perspective. And as I said earlier, if you couple that on in terms of the sort of strong technical demand that we're seeing for corporate credit, we think that credit spreads, are a relatively fair value in terms of the risks that are out there for companies. But overall, companies have done a really good job of managing a high interest rate environment in the context of an economy that's done better than what people were expecting, so continuing to get a bit of support from an economy that's performing far better than what expectations were, 6, 12, 18 months ago.
And thinking back to the start of your career, what's sort of one tip you've picked up along the way that might have been useful to know back then?
I think, probably a bit of a stereotypical answer, but I think, if I could go back to when I started my career, I think, don't be afraid to make mistakes. Taking risk is part of the job, and, it's important to take a well-educated risk to generate that outperformance and returns. But obviously, when you do, and if you do make mistakes, it's making sure you take the learnings from those mistakes going forward with the rest of your career.
And who would you say has had the biggest impact on you as an investor?
Yeah, I joined the Liontrust on the graduate programme originally, so I've only worked within, the team that I currently sit in, the Sustainable Investment team, and I think naturally, you are influenced by the more senior members of that team that have that longer track record and that great experience, and so leveraging off, that experience that we have within the team on the Sustainable Investment team at Liontrust has probably been the biggest influence on my career so far.
And outside of work, how do you switch off?
Well, actually, me and my wife just had our first child, so we've got a 5-month-old baby at home, so there isn't a lot of time for switching off. But being based up in Scotland, we try and make the most of the sort of amazing natural landscapes that we have around, going to the beaches and even going and hiking in the mountains, and that's really how we try to switch off, mostly in the summertime though.
Jack, thank you for joining us.
Thank you very much.